Is the house market in New Zealand really crashing? Today, we're going to look at the New Zealand housing market, since it has been going through major shifts lately. This could also give us more important information about larger trends in the world economy. Today, we'll talk about what's causing these changes, how they're affecting people in the business, and what they might mean for other developed countries, like Australia and Canada. So without further ado, let's get started. New Zealand's housing market has been getting a lot of attention lately because prices have dropped so sharply. This isn't just a short-term drop. It looks like the start of a big correction. A very important part of this story is the Reserve Bank of New Zealand, RBNZ. They just recently chose to keep the official cash rate at 5.5%, but what they said and what they predicted is still useful information. A monetary policy statement from the RBNZ in August 2023 says that the central bank thinks the New Zealand economy will shrink in the second half of 2023. Several things led to this contraction, such as slower growth and the fact that high interest rates are still hurting local demand. Now, renters are feeling the effects of higher interest rates than most. The sudden rise in mortgage rates has caused people with mortgages to have to pay back a lot more debt. This increase in debts lowers people's extra income, which in turn affects spending across the economy. It's interesting that the full effect of these rate hikes hasn't been seen yet, because many people are still switching from lower fixed-rate mortgages to higher ones. It will take a few months for this change to wear away at the savings that will help people handle higher rates. Less spending by households is also caused by lower home prices. Homeowners feel less rich when their property values go down, which makes them less likely to borrow money and spend it. People who are less sure about their finances may spend less, which can hurt the business as a whole. We're going to pause for just a few seconds here to ask you to subscribe to our channel if you're appreciating the content. Anyway, this is where things get interesting. Like Australia and Canada, New Zealand has been getting a lot of new residents. In fact, they are on track to have the biggest net immigration numbers each year in 100 years. At first glance, this influx may look like good news for the business, but it hides a bigger problem. When there is a weak economy and a growing population, economic growth per person slows down. This makes people feel worse off financially. The estimate for cash rates is one of the most important parts of the RBNZ statement. In May, the RBNZ said that they thought interest rates would go down faster than they did, but their most recent statement suggests a different path. According to the Monetary Policy Review, there is a 40% chance that interest rates will go up again because of this change. It doesn't look like the cash rate will go below 5.5% until 2025, which is a long time given how bad the economic picture is. Just a few weeks ago, Reserve Bank Governor Adrian Orr talked to Bloomberg and gave more information about the RBNZ's position. He stressed about how important it was to keep the official cash rate at 5.5% in order to keep inflation in check and keep the economy stable. From what the governor said, it sounds like he wants to be careful and prefer security to big changes. When people make decisions, the world situation is very important. Central banks around the world are worried about inflation, which is still high even though reported inflation rates are going down. This difference between average and core inflation happens all over the world, which could mean that the next move will be to raise interest rates instead of lower them. The RBNZ's plan to keep interest rates high for longer is in line with what most central banks around the world are doing. Interest rates in wealthy countries have been incredibly low for the past 15 years, which has made it easier for people to borrow large amounts of money to invest in real estate. The low interest rates caused house prices to rise falsely, and many people became dependent on these conditions lasting. If, on the other hand, interest rates stay high for a long time, this trend might change. Speculative investments and too much debt may come due, which could cause house prices to drop significantly. People who have a lot of debt on their homes might find it hard to adjust to higher rates, which makes forced property sales more likely. Other wealthy countries can learn a lot from New Zealand's experience with interest rates going up. When compared to the rest of the world, New Zealand was the first country to tighten monetary policy. Their rates were some of the first to go over 5%, which showed that they were serious about fighting inflation. This proactive approach makes New Zealand stand out and shows how important their economic strategies are. What happened as a result of their work will teach other countries how to deal with similar problems. There's also a strong link between the stock market and homes. Falling home prices affect more than just the people who live in them. They also affect the stock market. Since early 2022, New Zealand's stock market hasn't done very well. Even though it briefly tried to recover, it has not been able to reach the levels seen before the pandemic. This lack of progress makes people worry about the business as a whole. Fear among investors may spread to the real estate market if the stock market keeps going down. If both markets go down at the same time, people might decide to protect their savings over spending. As companies see their profits drop because people are spending less, they may decide to lay off workers, which could cause the jobless rate to rise. Things start to happen one after the other. A chain response could happen if the economy gets worse. If the real estate and stock markets go down, people might spend less, which could hurt business income and cause unemployment rates to rise. As unemployment rates rise, people with big debts may find themselves in tough spots and may have to sell their homes. There could be a crash in the housing market if a lot of people are forced to sell their homes at the same time. The chance of such an event happening depends on the state of the local and world economies. If the world economy goes into a slump, there is a much greater chance that the New Zealand house market will go through a severe correction. This brings up the question of what the future holds for the New Zealand home market. Looking at how New Zealand house prices have changed over time shows a trend of going down. In November 2021, the median price of a home hit a high point of $925,000. By January 2023, it had dropped to $762,000. Prices have been pretty stable over the past few months, but a closer look shows that they went down a little from June to July. Australia's typical house prices only dropped by about 10%, but New Zealand's housing market has gone through a bigger correction. This difference is due to the fact that each country has its own unique situations. Australia has had unusually few listings. The Reserve Bank of Australia has been less aggressive with interest rates, and record numbers of people have moved there. On the other hand, New Zealand's housing market might be a more accurate picture of how the market really is. During the pandemic, the government's unusual look of stimulus measures, interference, and very low interest rates pushed up house prices artificially. When these fake supports are taken away, prices will have to drop sharply. There is a lot of uncertainty about whether New Zealand's house market will recover or keep going down. A lot of things affect the future, but interest rates are the most important. If interest rates stay high for a long time, there is a greater chance that jobless rates will go up. At the moment, there haven't been many forced sales on the market because of unemployment, but if jobless rates go up a lot of homes could be put on the market. With all these listings and falling buyer confidence, the housing market could crash in a big way. The chance of such an event happening relies on both New Zealand's economy and the economy around the world. A worldwide economic downturn could tip the scales in favor of a major correction in the home market. To sum up, the housing market in New Zealand is an interesting case study that has effects that go far beyond its limits. Interest rates will likely stay high for longer because the Reserve Bank of New Zealand made this choice. This could affect the country's economic future and set a trend for other developed countries. Controlling inflation and keeping the economy stable are two difficult things that central banks all over the world have to deal with. People will pay close attention to New Zealand's housing market because it could show how the economy as a whole is doing. Feel free to share your thoughts in the comments below, and you can always check out some of the other clips on your screen for similar content.